Hello kids, from this video I'm discussing 2024 second paper and this is the latest for 2025, and from here I'm discussing the full paper from question number 1 to 6. Okay, so the first question is your company account. So this is a bit easy rather than comparing for 2023 because in 2023 the company account was the hardest one, right? So comparing to that, this is much easy, but there are some fresh adjustments. There are some nearly fresh adjustments that comparing to the last year's past papers. So let's see. First thing, the company has measured inventories at the lower of total cost of NRV. The total cost and the total NRV is given here as 5,600 and 6,200 respectively. So as up to that point, your cost is 5,600 and your NRV is 6,200. So by comparing those two, 5,600 is the amount that you have to record in your books, right? In the both places, in the cost of sales and inventories in SOFP. But after that, the net realizable value of one inventory item as at closing date, they later find out it is 450. It's lesser than 450. So if it is a one cost item is lesser than your cost value and NRV is lesser than your cost value, that you should mention, which means that you should add it to your accounts, right? So at that point, that 450 you should written off as stock written off in other expenses, and the stock that you should identify in your SOFP is 5,600 minus 450, 5,150. So 5,150 is the amount that you should mention in your SOFP under current assets after reducing that stock written off 450, and that stock written off you should mention in other expenses as well. And there is nothing changed for your cost of sales because in the cost of sales you have already found out the cost of sales in the in the trial balance. And when you're finding the cost of sales, you are considering what? The cost of the stock of the inventory. So there's nothing to change in cost of sales, right? The second thing, the trade receivables balance is shown in the trial balance after offsetting the trade payables balance of 2,550. So in SLP, you have to mention trade receivables and trade payables separately. So trade receivables in current assets and trade payables in current liabilities. But what they did here is they offset the trade payables balance and then the remaining balance is appeared in the trial balance as trade receivables, right? So that's incorrect. The trade payables balance you should mention in SOFP under current liabilities. And trade receivables, the balance shown in the trial balance is 3,450. To that, you have to add the offsetted trade payables value 2,550. So your correct trade receivables value or balance that you should mention in SOFP is 6,000, right? And then third one is very interesting as well. Cash and cash equivalents shown in the trial balance include investments in 3 months treasury bills and 6 months treasury bills, 600,000 and 1,500. So under cash and cash equivalents, you should mention 3 months treasury bills only. The 6 months treasury bills you should mention in current assets separately. You can't include the 6 months treasury bills under cash and cash equivalents. That's incorrect. Right? So in favor of the treasury bills investment, to that you should add that 6 months treasury bill value. So in treasury bills investment in current assets, you should mention 19,500 by adding that after that 6 months treasury bills. And is there any components of cash and cash equivalents like here, which means cash in hand and 3 months treasury bills like that? You have to have a separate note by mentioning what are the components in cash and cash equivalents. So here there are 3 months treasury bills and then the cash in hand, right? After that, this 2,300 you have to record in current assets as cash and cash equivalents. So keep in mind, if there are any component in cash and cash equivalents, you should mention that separately in a note, right? fourth one, the provision for warranty. For this year, they estimated as 1,050. And the last year provision in the trial balance is 900. And then in the trial balance, it says payment for last year is 600. So which means you did the over provision in the last year, but you can't go back and correct the financial statement of the last year. So what you have to do is the over provision that you made in last year, you have to uh, bring to this year, and that over provision you should minus from the total provision. So the warranty expense that you should mention in income statement is only 750. Mhm. The total provision for this year, 1,050, neither paid or nothing paid for this year. So that 1,050 totally you have to mention in current liability as sales warranty provision, right? In the fifth adjustment, they are giving information for the property, plant, and equipment. So here the cost and accumulated depreciation are given as in closing date. And here the estimated useful life at the date of acquisition, right? So date of acquisition, the useful life is given here. And here all these property, plants, and equipment are used for admin purpose. The depreciation of the current year has been correctly calculated and included in the administrative expenses. So nothing to change over there. But what you have to do is you have to find out the current year depreciation and mention in your note, right? And there were no purchases or disposals of the property, plant, and equipment during the year. And here the company had revalued its building for the first time on 31st March 2023. So this is very interesting here because the revaluation that they did on 2023 March 31st. So this financial year is starting from 1st of April 2023. So this revaluation was made before the financial year started, right? So that which means that revaluation they did in the last year. So nothing to do the revaluation for this year, right? So they revaluate the buildings for the last year 48,000. So that's the opening balance of this year, right? Because they did the revaluation in the last year, and then they found out the surplus is 7,000,000, 7,000. And revaluation had been properly accounted, right? And here, so when you're finding out the buildings depreciations, buildings accumulated depreciation is 4,000. So this is the depreciation that they made in this year, right? Because they revaluate buildings in the last year for 48,000. And for 48,000, the building's revaluation, building depreciation is 4,000. So that's why the accumulated depreciation is given as like this. Because when you're doing the revaluation, what you are doing, you have to transfer revaluation from accumulated depreciation up to the to find out the carry number, right? Okay, so as in opening date, there is nothing on buildings depreciation because you did the revaluation on the last day, on the last year. So there is nothing in opening date, and the depreciation that they made for this year is 4,000, and that's what appeared in the uh, closing balance as well, right? Then ගොඩක් ළමයි මේකෙදි වරද්ද ගන්න they are finding out they found the depreciation by dividing 48,000 by the 20 years. And that's incorrect because here 20 years is the estimated useful life at the date of acquisition, not the remaining useful life. Got it? There is a very simple thing that you have to make here. You have to do the current year depreciation you have to mention here. And there is nothing in opening balance, and that's it. But to understand that, you have to get the clear idea that they did the revaluation in the last year's closing date, and there is nothing more in opening date accumulated depreciation because they transferred in the last day to find out the carry number, right? That's a bit interesting, and I like that. And there is another problem. If I recorded the revaluation surplus correctly, so in the trial balance, there should be 7,000 in revaluation reserves, right? But up to that point, after you checking, up to that point when you're checking the trial balance, there is only 6,000. There is something happened. So let's see what happened. The cost and the accumulated depreciation of office equipment as at 31st March 2024 were 16,000 and 3,000 respectively. And these are the closing balances of the closing date. And the company revalued the office equipment for the first time and for the fair value of 12,000. And that 12,000 is what is the amount that mentioned here. Because here the revaluation they recorded correctly, right? So what you have to do here, you have to show the revaluation here because this revaluation was done in this year, right? So the opening balance you should mention here as 16,000 and the closing accumulated depreciation is 3,000, right? So 12,000 divided by 8, uh, no, not 12,000, sorry, 16,000 divided by 8, the current year depreciation is 2,000. So if so, the opening accumulated depreciation should be 1,000, right? So the total depreciation that you should transfer from here to here is 3,000, and that's how you found out the 12,000. And the revaluation deficit that you found from here, what they did, they transferred that to the revaluation reserves of the buildings. That's interest, right? So that's why the 7,000 is in the trial balance is mentioned as 6,000 because they transferred the office equipment deficit to the revaluation reserves of the buildings. So you have to correct over there. So in changes in equity, the revaluation reserves opening balance will be 7,000 and the office equipment depreciation, sorry, office equipment deficit that you are finding from here, you have to mention in other expenses, right? So that's how you have to do the property, plant and equipment adjustments. Sixth adjustment is about lease, and here the company entered into a lease agreement on 1st of April 2023, which means the opening date, to obtain the right of use of a building for the period of 5 years. So this is operating lease because they obtained this building only to use for 5 years. On this day, the cost of the right of use of asset and the initial lease liability have been correctly accounted as 10 million. According to the lease agreement, 5 equal annual installment of 3,200 each is payable during the lease terms commencing from 31st March 2024. The first installment has been paid on 31st March 2024 and recorded as an admin expense. That's totally incorrect. So that lease payment you should minus from administration expenses, and no other accounting entry have been made in the relation to this installment payment. The lease interest applicable for the year ending this year 1,800 and the next year 1,548. The building should be handed over to the lessor at the end of the lease term. So which means, as I mentioned earlier, you have to find out the depreciation based on the lease terms, not the useful life. But what they did, they depreciated based on useful life and they recorded depreciation, right? So you have to turn over that entry and find out the correct depreciation and recording administration expenses, right? So in the note, right of use of lease property, cost of the building is 10 million and divided by 5 lease terms, that is 2,000, the current year depreciation, and your carrying amount is 8,000. So this is the amount that you should mention in your non-current assets, right? But what they did, they did the depreciation based on useful life, and that's incorrect. Which mean by dividing 10,000 by 20 useful year. So the incorrect depreciation you should minus from administration expense, and then we have to write down the corrected depreciation in administration expense, right? And the lease interest you have to record in finance expenses. So in the lease liability account, the opening initial liability is 10,000 and the current year interest 1,800 that you should credit to the lease liability, and the installment payment after debiting to the lease liability, the balance carried down is 8,600. So what you should do, this 8,600 you have to split between current liabilities and non-current liabilities. The current portion, the credit portion that you are going to pay in next year, you have to mention in current liabilities, and the other portion, the remaining amount, you should mention in non-current liabilities, right? So from the installment, you should minus the next year interest, 1,548. So your current liability amount should be 1,652, and the non-current liabilities, after reducing that current liability portion, 6,948, right? Seventh adjustment is about income tax, and income tax paid shown in the trial balance consists 600 paid for the last year and the tax paid for the first 3 quarters of the current year. The total income tax liability for the year ending was estimated as 1,100, and the last year provision in the trial balance is 550, but they paid for the last year 6 months, so which means they did an under provision in the last year. And the tax expense in the income statement, you should mention after adding that under provision to the total tax is 1,150, right? So this is the tax expense that you should mention in in income statement. But the total tax expense for the year is 1,100, and you already paid 800 for this year's first 3 quarters, and the remaining amount is the tax payables that you should mention in SFP current liabilities. The last adjustment here, the stated owner share capital as at 1st of April 2023 consists of 4 million shares issued at 10. The company capitalized retained earnings in the proportion of 1 share for every 5 shares held on this date at the consideration of 12 per share. No adjustment has been made in this respect in the books of accounts. So there were 4 million shares. So 5 into 1 mean they issued 800,000 shares at 12 per share. So the capitalized retained earnings amount is 9,600,000. So retained earnings debit 9,600,000 and stated capital credit 9,600,000. This transaction you should mention in changes in equity. And yes, actually that's it for the company account question. And now we are in second question. Second question A part. Amara PLC is a manufacturing entity, requires 10,000 units per annum of a raw material item. The purchase price per unit of this raw material is 2,000. The ordering cost per order of this raw material is 5,000. The annual holding cost per unit is 20% of its purchase price, so which means 400, right? The maximum stock level and the minimum stock level of raw materials are given here 700 and 200, and the reorder level of this raw material is 600 units, and its average lead time is 2 weeks. So first of all, they are asking the economic order quantity. So how to find out the economic order quantity? 2 into demand into cost of order divided by cost of holding, and these all you should mention in under square feet. So your EOQ is 500 units. And then they're asking the number of orders per year. The annual demand is 10,000. And if you purchasing economic order quantity at once, so 10,000 divided by 500, you have to order 20 times per year, right? And the average stock level. So how to find out that? Minimum stock level plus maximum divided by 2. And it's very easy because the minimum stock level and maximum stock level is given here directly. And that addition you should divide by 2, then you can find out the average stock level. And then they ask in the average consumption per week, and to find out you have to go with the minimum stock levels equation. So how to find out the minimum stock level equation? Reorder level minus average consumption into average time. So here you know the minimum stock level, you know the reorder level, and you know the average time as well. So here you had to find out the average consumption. So your average consumption is, by extracting that equation, is 200 units, right? And yes, now we have to do the production overhead thing, and this is very interesting because this is very uh, difference by comparing to the last years, because here there is a error correction that you have to do. The accountant, they already found the assembly department and finishing department absorption rates but that's totally incorrect. So you have to revise the production overheads, and then you have to find the adjusted absorption rates, right? So this is very interesting, and I am hoping in 2025 it also will come with uh, production overhead adjustments like this, right? So here, Noreen PLC produces two types of product A and B. The company consists of two production departments, namely assembly and finishing, and a service department, stores. The accounts assistant of the company had calculated the following overhead absorption rates for the next year at the activity level of 3,000 units. And here, this activity level is consist of 2,000 units of product A and 1,000 units of product B. Assembly department and finishing department, the drafted absorption rates per machine hour and direct labor hour is given here. Subsequently, it was revealed that the following errors have been done by the accounts assistant in calculating these overhead absorption rates. So these are the errors that they did. So budgeted machine hours for assembly department and budgeted direct labor hours for finishing department had been erroneously used as 65,000 and 35,000 respectively. So from these, you can find out the drafted overheads, right? So 20 per machine hour, and they use machine hours as 65,000. So by multiplying the 20 by 65,000, the assembly department's production overhead is 1,300,000. And when it comes to the finishing department, they got labor hours as 35,000 and per labor hour 30. So multiplying that, the drafted production overhead for finishing department is 1,050. The total non-production overhead 720,000 has been portioned equally between assembly and finishing department. That's totally incorrect, right? In the production overhead distribution, you are not recording the non-production things. So you have overturned that. So which means that non-production overhead you have to exclude from drafted production overheads. And then stores, the correct value is 720,000, sorry, 210,000, but they uh, redistribute among assembly and finishing is 150,000. They undervalue the stores department's production overhead. So the difference of that, you have to again distribute to the assembly and finishing department as 2:1 ratio, right? And then the indirect wages, directly you can allocate it to assembly department and finishing department. And that special equipment rent for the assembly department, 420,000, also you can directly allocate it to the assembly department only. And then insurance premium for machinery, 170,000. And here, to distribute that, you can use the base as here in the additional information. It's specifically saying machinery insurance premium relates only to assembly and finishing department. The value of machinery of assembly and finishing department is 16 million and 18 million. So the simplest ratio of that is 8:9. So dividing 170,000 as in this base, 80,000 and 90,000. And to distribute electricity, you can use kilowatt hours as the base, and that's how you have to do that. And then the staff welfare, and to distribute that, you can use number of employees for assembly and finishing department. So the adjusted production overhead, the total production overheads that assembled in assembly department is 2,200,000, and in finishing department is 1 million. And then the corrected budget machine hours and labor hours are given here. So by dividing that, you can find out the adjusted absorption rates as 55 and 50 for assembly department and finishing department respectively, right? And after all, you have to find out they're asking cost of production per unit of product A and product B. So the prime cost is given directly, and the assembly department and finishing department absorptions here. and then you can find out the production cost. And then their margin, yes, the profit margin is 40%. So after adding profit margin, you can find out the selling price of each product A and product B, and then you can find out the production cost and selling revenue. Right? Yes, they're asking the production cost and selling revenue. So that's how you have to do the second question, and let's move to the third question. In third question, it's a usually equation question. The following transactions were taken place in the business during the month of October 2024, and they given the format of the equation, and we have to record these transactions from number 1 to 12 in the given equation, right? And then they are asking to find out the gross profit as well. And there are balances, so you have to put the balances first. And here the first thing, the owner provided 120,000 cash as additional capital. So your cash should increase by 120 and your equity should increase by 120. And then the received other income of 20,000. So your cash should increase by 20 and the equity should increase by 20 because the income, expenses, borrowings, and internal capital you have to record under equity, right? And then the third one sold the two computers which were available in the opening inventory for 295 each for credit inclusive of 45,000 VAT. So here the special thing is VAT. So when you are doing sales, you are collecting VAT. So which means that VAT you have to pay to the government. So that collected VAT is a liability for you. And when you are doing purchases, you are paying that VAT, right? So when you are doing sales, that VAT you should add it to the liabilities. And when you are doing purchases, that should minus from VAT liabilities. So the here inventories, it should minus 250. That means excluding VAT. So 250,000 worth of inventories you are selling for 590 inclusive VAT. So debtors should uh, increase by 590, but the net sales here is 500. Because if it is a VAT registered business, you have to record the purchases and sales without VAT, right? So the debtor's value is 590, which means the credit sales total value. But after excluding VAT, your net sales value is 500. So what here doing is you are selling 250 worth of inventory for 500, and from that you are getting the profit 250, and that profit you should add to the equity. And the VAT collected from that sales you should add to the VAT liabilities. Fourth one, fourth one. Yes, in the fourth one, you are paying to the creditors 150,000. But when you are settling that 150,000, you are getting a 10% cash discount. So here it says paid 135,000, and that should minus from the cash opening trade creditors after receiving a 10% cash discount, right? So your discount is 15, and that is a discount that you receiving. So that should add it to the equity, right? Fifth one, purchase three computers on credit, 118, inclusive 18,000 VAT. So under inventories, the purchaser, you should record the excluding VAT, 300. And the VAT paid at the purchasers, you should minus from the VAT collected here, 54. But the creditors should increase by the total with VAT, 354. Sixth one, a computer costing 100 available in the inventory was obtained by the owner for his personal use. So inventory should minus and then equity also should minus. Seventh one, a computer costing 100,000 is available in the inventory was provided for the office use. It's also interesting. Here what we are doing, we are converting inventory for the officers, property, plant and equipment, right? And eighth one, what here doing, you are selling 100,000 worth of a computer worth 100,000 for 177 in cash, and the VAT collected from that is 27. You should add it to the VAT liability. And here you are selling 100 for net sales 150. So from that you are getting a profit 50, and that profit you should add it to the equity. On operating expenses payment, cash minus and the equity minus. And the 10th one, received 120,000 from opening trade debtors to settle, sorry, allowing 6,000 discount. So debtor should minus 126, but the cash should increase by 120, and the discount that you allow to the debtors is an expense, so that should minus from the equity. 11th one, purchase two computers for cash 147,500, inclusive 22,500 VAT. So here in the under inventories, you should add inventory at the VAT excluded value, right? And that VAT paid at the purchases, you should minus from VAT liabilities, and your cash should minus the total 295. 12th one, the closing inventory as in closing date was measured in the net reserve value of 200,000, and the difference between the cost and NRV was recognized as an expense. So here, this is much interesting. When you are calculating up to this point, your value of the inventories is 250. But the NRV that they calculated is 200, so the closing balance should be 200. And the difference of cost and NRV is the stock written off. That is an expense. You should minus from inventory and from equity as well. And then they ask you to find out the gross profit. Here the total sales 650. And when you're finding the cost of sales, opening stock and purchases, and then from that you have to minus the drawings, office use and closing stock. But here you have to minus the closing stock at cost value, not for the NRV, right? Then you can find out the gross profit. So when you are recording sales and purchases here, you have to get the sales and purchases without VAT, which means excluding VAT, right? In the B part, it's given the information about non-profit organization. A welfare society had 200 members as in opening date, and the annual subscription per member is 12,000. The following information relates to the welfare society for the year ending closing date, and they are given three parts: life membership, annual subscription, and donation. So in life membership, the welfare society introduced a life membership scheme on 1st of April 2023. So the life membership fee is equal to the annual subscription for 5 years, and this amount is required to pay at once on the date of the life membership is obtained. The policy of the society is to recognize the life membership fee as income equally over a period of 10 years starting from the year of the receipt, and 50 existing members and 10 new members obtain the life membership on opening day. So which means altogether 60 members, they started the lifetime membership fund. So 60 into annual membership 12,000 into 5 years. So the total amount that they received in cash for the lifetime membership fund is 3,600,000. And from that, the policy is to identify this total within 10 years in the income statement as the income. So 3,600,000 divided by 10 years, 360,000 is the amount you should identify in your income statement as the income, and then you have to mention the closing balance as well. And in the normal membership fund, there was no subscription received in advance or subscription in arrears as in opening date, and no new members joined the society during the year other than that 10 new life members, right? So there were 200 members at the initial date, and from that, 50 members convert their membership as the lifetime membership. So there are 150 membership normal members, right? So 150 into 12,000, whether you receive in cash or not, the total income is 1,800,000, right? And then 140 members pay the annual subscription for the current year, which 15 members pay the annual subscription for the next year as well. So 140 plus another 15, the total amount that they received in cash is 1,860,000, which means that 15 members subscription you should identify as subscription received in advance, And then the other 10 members you have to recognize as sufficient receivers. So that's how the membership account you should draft. And in the donation, the Welfare Society received a donation of 1 million. So cash debit, donation account credit to build a sports center. From this donation, 100,000 was paid uh, for design of the sports center, and the construction of sports center was commenced on 1st of Jan 2024. Up to that, 400,000 was payable. And their policy is to identify the donations as an income with the based on the amount utilized, right? So totally they utilized 500,000 from donations to build that sports center. And that 500,000 you should transfer to the income statement as well, right? In fourth one, that is the question about the prime entry books. Amran Private Limited conducts a trading business. The company purchases goods only on credit basis and sells goods on both credit basis and cash. This company is registered for value-added tax, so which means you have to record the VAT in a separate account. So here these are the balances, and then the sales during the year. There are two credit sales and one cash sales, and two credit purchases, and then they are given the cash receipts and cash payments. And then they are asking to draft the prime entry books. So here the cash receipt journal, and when it says VAT registered, which means in every prime entry book there should be a separate column for the VAT, and then the discount allowed as well in the cash receipt journal, and the discount received in cash payment journal. So initial debtors, they received 295, and it should mention on the debtors as well. And then from debtor Vimal, after allowing 25, they received 683. So that discount you should mention here, and then the amount here. And the cash sales is 236, including VAT 36, and that VAT you should mention under VAT analysis column. And sales you should mention the net sales value. So the total amount is 236, and then you can get the totals here. And in the cash payment journal, they are paying to the opening trade creditors 118, and then the VAT they are paying 27. So it should be comes under other payments over VAT payment. That's also okay. And also the company, uh, we settled to them to 796 after getting a discount 30. And then the operating expense should be expenses. Then you can get the totals. And here the sales journal and purchase journal. Here there are two sales, credit sales and two credit purchases. So when it says VAT register, you have to exclude the VAT and so the net sales and purchases here with the totals, right? And after that, you have to go for the journal entries. So the totals of each prime entry book, you have to go with journal entries. So here the cash account, here the journal entries of the cash receipt journal, and it specifically mentioned that they are asking the narrations as well. So you have to mention narrations, right? So when the cash receipt journal, cash account debit, and each account should credit, and then you have to record the discount allowed separately, discount allowed debit and debtors credit. And in the cash payment journal, cash credit and the other accounts debit, and then the discount received, creditors debit and discount allowed credit. And then when you are recording the credit sales and credit purchases, you have to record the VAT separately. So debtors should debit the total, but sales should credit without VAT, just the sales amount, and VAT should credit as well. And when it's record to the credit purchases, total it should credit to the creditors, but purchases and VAT it should in purchaser it should mention without VAT, and that VAT is debit to the VAT control account. So that's how you have to answer question number 4. In the B part, they are given some ratios. They are given some information, and from that they are asking these ratios. And first thing they're asking the gross profit ratio. So how to find out the gross profit? So in gross profit, they're asking the gross profit percentage based on sales. And here the gross profit is not given directly, but they are given the sales and cost of sales. So from deducting cost of sales from sales, you are getting the gross profit. And your sales is 1,000. So the gross profit ratio here 2,000 and here is 40%. And net profit ratio they are asking, so which mean the net profit percentage based on sales. And here the net profit is given directly, yes, 180. So 180 based on 2,000 is 9%. And then they are asking the stock turnover. And to find out stock turnover, cost of sales divided by average debtors. So here the average debtors is given, not given, but you have to find out the average debtors. How to find out that? Opening inventory plus closing inventory divided by 2, right? And then they ask in the quick assets ratio. So quick assets mean uh, how many quick assets are there to settle one current liabilities. And in quick assets, you are only should consider debtors and cash. You are not considering inventories and prepayments in current assets when you're finding out the quick assets. So your quick assets should be 280 and the quick assets ratio is 1.4 times. And then they're asking the profit on equity, and the equity is not given directly, but the equity is stated capital plus reserves, right? So here the stated capital is given as 300 and the retained earnings is given as 200. So altogether, the total equity is 500 and 180 as a percentage of 500 is 36%. And then they are asking debtors collection period and to find out average debtors divided by sales into 360 or that 360 you have to divide by in debtors turnover, right? So average debtors, initial debtors plus closing debtors divided by 2. So this is much easier, right? The whole information is given to you. And if you know how to find out, which means the ratios equation, then can extract these things and find out the uh, ratios, what they ask you, right? And C. And C is given from investment decision. A company is considering a project to purchase a machine costing 2,500,000. This machine is expected to use for a period of 5 years. And at the end of the 5th year, the expected residual value of this machine is 500,000. And the disposal value you should mention in last year as a cash inflow. And here is given the years and number of sales. So the selling price is given here separately. And it is expected that the selling price will increase to 600 and 750 in year 4 and 5. So you have to get sharply the sales revenue up. In first 3 years, selling price per unit is 500. So number of sales you have to multiply by 500 to find out the sales revenue in first 3 years. But for the last 2 years, the selling price per unit is different 600 and 750. So in the fourth year, 6,500 should multiply by 600. And in the last year, 4,000 should multiply by 750 to find out the sales revenue, right? And the annual direct operating cost is estimated as 50% of the sales revenue. And from this, you have to get the 50% as for the operating expense. And then the annual indirect cost, including depreciation, is 1,100. So when it says including depreciation, and when you are recording the cash flows, you have to exclude the depreciation from the expense. And when you're finding the depreciation, the cost of the machine is 2,500. There is nothing about the direct payments. And 2,500 minus the disposal value 500 and then divided by 5. So your annual depreciation here is 2,000 divided by 5, 400, right? So from 1,100, you have to minus 400, then you are getting the indirect cost. So those are the cash payments, and here the cash total cash receipts. Then from that you can find out Yes, then you can find out net cash flow. And the net cash flow you can multiply by the discount factor, then you are getting the present value. And when you're finding the NPV, the total of present values of future cash flows minus initial outflow. And it is a plus value for the NPV, net cash flow. So that is 2,353. So this investment is okay to be proceed because NPV is a plus value, right? In the fifth question, it's about partnerships. There are two partners there were, Lal and PL, and then they recruited their manager as the new partner at the end of the year. And that adjustments you have to do at the final stage. And then here the agreement is given like this, and the Kamal was recruited as the closing date, and he was the manager of the business. And for this year, he is still a manager, still the manager. And the bonus, the annual bonus that for his employment contracts 1 million, and at the recruitment, the management decided to treat that as the capital that he brought to the business. But still, that is an expense for this year because in this year, the Kamal was the manager, right? So the bonus for him you should consider as the expense. So in administration expense, the draft is 3,800 that is extracted from the trial balance, and to that you have to add that bonus, right? And here the interest on capitals of the partners for the current year have been debited to the other expenses and credited to the expense account. That's totally incorrect. Interest on capital is the way of distributing profit, and it should mention in the appropriation account. But instead of that, what they did, they debited to the other expenses. So from the other expenses, you should minus the interest on capital from both, and you should mention in the appropriation account. So which means those two you should credit to the current account. During the year, Lal has drawn 6 months' salary in cash. Further, Pierre has drawn the entire salaries for the current year, and they in cash during the year. The total salaries drawn by the partners in the cash have been recorded in admin expenses, right? So from admin expenses, it should minus. And the interesting thing is, PL is withdrew the April salary as well. So here it should minus 1,300, adding that April withdrawals, right? So Lance salary and PL salary, that withdrawal things they recorded in administration expenses, that's incorrect. The salaries that they withdraw from each partner should debit to the current account, and it should deduct it from admin expenses. Interest on the loan provided by Lal for the current year neither has been paid nor accounted. So the loan account from Lal is 1 million, and in agreement it says partners are entitled to receive a 10% interest per annum on loans provided by the apart from the equity, and then 1,000 to 10% the interest should be 100. So interest and bank expense 100, and that 100 you should credit to the Lal's current account. During the year, Lal and Pierre have been taken goods costing 300 and 200 respectively from the partnership, and it should debited to the current account as drawings, and uh, they recorded cost of sales without recording that. So from your cost of sales, those goods drawings you should minus, because when you're doing the goods drawings, you should minus from the cost of sales, right? And then during the year, Kamal has taken goods costing 100,000 for his personal use. No adjustment have been made in the books of accounts in this respect. When Kamal was admitted as a partner, the other partners agreed to treat the goods taken by him as a gift given to him by the partnership. So here, this drawing, you can't treat actually as drawing because Kamal is still not a partner of this year, part of the partnership for this year. So the drawings that made by the Kamal, they treated as a gift that that Lal and Pial given to the Kamal. So again, that should minus from cost of sales as well. That donations here, you can't Debit to the current account is normal stock brokers because Kamal is not a partner still for this year. And that donation is an expense and it should record under other expenses, right? So recording all those cases in the current account, balances, interest on loans, interest on capital and salaries, and the drawings done by Lal and PL, the stock drawings, and the salaries that they withdraw. Lal withdraw for first 6 months and PL withdraw for the full year plus the next year's April salaries as well. Then you can find out the balances for Lal and PL. And when it's come to the capital account, you have to record the recruitment of the new partner in the capital account. So the Lal and PL's opening balances they given 4,000 and 2,000. And the Kamal's capital, that bonus they treated as the capital, and then the goodwill adjustment. So always, either recruitment or retirement, that doesn't matter. You have to adjust the goodwill for the old ratio credit and for the new ratio debit. So that's how you have to uh, do the partnership correction here. And then there's another interesting thing, bank reconciliation statements and adjusted cash account. So Garmin is carrying out a consultancy service business. All cash transactions of this business are carried out through a bank current account. The debit balance of cash account as in closing date is 35,800 and that should be the opening balance of adjusted cash account. And the bank statement balance on this date did not agree with the cash account balance. The bank statement was received as in closing. The bank statement balance, yes. The bank statement balance and the cash balance is different. And these are the reasons for the difference. On 15/12/2023, a consultancy income 60,000 has been directly remitted to the bank. So that should debit when you are drafting the adjusted cash account. And then the bank has paid standing order payments. So standing order payments, it should credit to the drafted cash account. And bank charges also you should credit. And there is a check issued 80,000 for payment for rent. They recorded that in twice in the cash payment journal. So when you are correcting that 80,000 payment, you have turnover one day. So that should debit to the adjusted cash account. And bank has debited bank charges, it should credit. And then issued for payment for electricity charges has been dishonored. And that dishonored check also you should debit to the adjusted cash account. Then you can find out the balance here, adjusted cash account balance, and then we are taking that to the bank reconciliation statement as the base, and from that you are finding out the bank statement balance. And the issued but unpresented check is 50,000, it should not. And deposited but unrealized is 45,000, it should minus, then you can find out the bank statement balance. All good here? Yes. If you have any question or something like that, just comment or WhatsApp me straight away. Okay, 6-1. In the first question, they are asking to prepare the uh, cash flow statement, and there are additional informations and opening and closing balances as well. So here, this cash flow you have to draft based on indirect method because the profit before tax they are given straight away, and this profit before tax you have to get as the base of the operating activities. And the difference of that is your tax. And yes, you have to adjust tax from that. Depreciation of property, plant and equipment and depreciation of right of use of assets. These things you have to add back to your at the adjustments, right? And the company sold a motor vehicle for cash with a profit of 800,000. The carrying amount of this motor vehicle on this date is 2,600. And that disposal profit you should minus at the adjustments in operating activities. And the carrying amount plus that profit is the sales proceeds that you received when you are selling that motor vehicle. And that you should mention in investing activities. The company entered into a new lease agreement to obtain the right of use of motor vehicle on 1st of April 2023. On this date, the initial payment was also made. The present value of lease payments was 5,400, right? And from that, you have to find out that initial payment, and to find out that you have to draft the right of use of lease property. And right of use of lease property, the difference, the carrying amount is given as in opening and closing date. Opening 7,000, and then the closing date balance is 12,000. And the depreciation of that right of use of lease property is 1,400. It should credit to the right of use of lease property. And the lease creditor, uh, yes, the initial lease credit is 5,400. It should also debit to the right of use of lease property. So by balancing this, then you can find out the initial payment, investment decision. Sorry, yeah, it should mention under investment decision. And this is how to find out the initial payment at the lease when you are getting the lease property, right? And then balancing the lease creditor, the opening balance is 5,500 and the closing balance 8,900. It should credit the new motor vehicle lease, initial lease liability. Then you can find out the lease creditor payment, right? And when you're balancing the property, plant, and equipment, you purchase, yes, you purchase a new machine. So balancing the property, plant, and equipment, you have to find out the new machine purchases. So opening balance and closing balance is given, and the depreciation is given. And that motor vehicle disposal carrying amount you should credit to here. Then you can find out the new machine purchase value, right? And from the retained earnings, you have to find out the interim dividend payment. Opening balance and closing balance is given, and the profit after tax you have to credit to the retained earnings. And then they capitalize 2,500 from the retained earnings, then the dividend payment is 850. And that should mention in financing activities as a cash outflow. So that's how you have to do the operating activities of the cash flow. And the difference between profit before tax and profit after tax is your tax. But there are opening and closing tax payables. So by balancing those, adjusting those places, you can find out the tax that you paid, the cash paid for the tax. And then you have to get the working capital changes. Inventories, there is a increasement, so that difference you have to treat as a cash outflow. Trade receivables is also an increment, and the difference you should consider as cash outflow as well. And the decrease, sorry, and then the trade payables, there is a decrease, yes. And that decreasement you have to consider as cash outflow as well, right? Yes. So here PP depreciation and lease assets depreciation you have to add here. And is there anything for interest? Yes. The lease installment interest is 900, and that interest you should add here. And then you have to minus the interest paid here as well. Okay. So that's how you have to draft the operating cash flow with working capital changes. And then investing activities, we already, you have to find out the machine purchases from preparing property, plant, and equipment at the carrying value. We mentioned it earlier. And the motor vehicle carrying amount is 2,600, and the disposal profit that you are getting from that is 800. So which means the sales proceeds that you are getting from the motor vehicle disposal is 3,400. And the initial lease payment you have to find from right of use of assets. We already discussed there. And the initial lease payment you have to consider as investment activities. But the lease installment excluding interest is, you should mention, is under financing activities, and issuing shares you are getting cash under financing activities, and the dividend payment you have to mention, find out from the retained earnings account we mentioned earlier. And that's how you have to prepare the cash flow statement for question number 6. And the last part of the exam paper, CVP analysis. The management of preschool is planning to hold a sport meet during Jan 2025. The preschool has 70 students. The expected cost of the sport meet are as follows. So when it comes to these types of question, you have to find out, you have to find out the first unit of this scenario. And here the question is per student. So if there are any expenses or cost items that differ based on the number of students, so those comes as variable cost, but if not, those comes as fixed cost, right? So then they ask in the total fixed cost and variable cost per student. Here the per student is uniform per student variable cost, food packet per student variable cost, certificate of participant variable cost, but the gifts, hiring chairs, decor, preparing sport ground, sound system, and food for guests all comes under fixed cost. Okay. And then they are asking if 7,500, if they are charging 7,500 for one student, how many students should participate to cover the total cost, so which means they are asking the break-even point. So at that point, your contribution is 3,000, 7,500 minus 4,500, the variable cost. Then the break-even point is 50 students. And surplus, if all students participate, you can find out the total contribution, 70 to 3,000, and from that you have to deduct the total fixed cost. Then you can find out the surplus as 60,000. And then they're asking if per student 9,500, what is the break-even point? So at 9,500, your contribution is 5,000, 9,500 minus variable cost, and the break-even point is 30 student. And if uh, 55 students participate, the students to cover is 30, so which means the margin of safety is 25. And then they're asking fee to be charged if the donations are receiving for, as in 45,000. So fixed cost is still remain unchanged. And if 60 students are participating, the total variable cost that you have to cover is 4,500 into 60. And from this is the total cost, fixed cost plus variable cost. From that, you have to minus the donation. Then you can find out the cost to cover as 375. And then you can find out per student as 6,250. Okay. This is of the 2024 question paper, and I discuss all question number from question number 1 to 6. And if you learn at least a word, at least a vachana karigena kasama, please do a comment, share with your friends, and good luck for your exams as well. And if you're willing to purchase my books, just send me a message through WhatsApp. Okay. So we will meet some another lesson or some activity from another account. So until that, goodbye. Ciao, ciao.